This is Ankit Thukral from Edupedia World. Students, in the previous session, I had started with the chapter on sources of business finance and covered what is the nature and significance of business finance, what is the need for business finance, what is the financial needs of a business, and classification. Further, I had covered classification of sources of various funds. That means on period basis, ownership basis, and source of generation basis. On ownership basis, further, the classification was done into owners funds and borrowed funds. In brief, the owners funds were discussed with the various sources of owners funds. To recapitulate, I may tell you that in brief it was discussed various sources of owners funds, that is equity shares, preference shares, retained earnings, and global depository receipts, ADRs and IDRs, etc. Now today I am taking up owners funds in detail one by one. As you are aware that owners funds are the funds provided by the owner of the business enterprise. So simply, these are the funds provided by the owners of the business enterprise. Out of various sources of owners funds, let us discuss on number one category is equity shares. Equity shares are the main source of finance of a firm. It is issued to the general public. Equity shareholders do not enjoy any preferential rights with regard to repayment of capital and dividend. And let me tell you that equity shares are the most important source of raising long-term capital by a company. The shareholders are entitled to residual income of the company, but they enjoy the right to control the affairs of the business, and all the shareholders collectively are the owners of a company. This is the concept of equity shares. Let me define you what exactly is equity shares. What is equity share? As I can define it like that, those shares which do not carry any special or preferential rights in regard to payment of annual dividend and repayment of capital. Further, it represents the owner's capital, as equity shareholders are the real owners of the company. Thus, the capital raised by issue of such share is known as ownership capital or owners funds. For example, when a company wants to raise capital, it borrows from market by issuing shares to persons who wants to invest in the company. The nominal value of the shares is determined by the company. When an investor invests the amount, the company issues shares according to the determined value, that is, and a certificate is given to the investor for the amount he has invested and for the number of equity share he has invested in the company. So this is what equity share is. The capital of a company is divided into small units called shares. Shares is the interest of the shareholder in the company, which is measured in the terms of money. Share means a share in the share capital of a company, and it includes stock also. The capital obtained by issue of share is known as share capital. Each share has its nominal value, and holders of these shares are called shareholders or members of the company. The shareholder receives dividend from the company as a consideration for investing his money. A public company can issue two types of shares: equity shares and preference shares. Here we are discussing equity shares. Now let me tell you what are the features of equity shares. One by one, let me tell you that number one is risk bearer capital. The equity shareholders are the primary risk bearers. They enjoy the reward as well as bear the risk of ownership. Second feature is maturity. Equity shares provide permanent capital to the company and cannot be redeemed during the lifetime of the company. This is one of the main features of equity shares. Third is return. The return earned by the equity shareholder is known as dividend, which varies with the earnings of the company. If a company earns more, it can declare more dividend, and equity holder accordingly get the more dividend. That is his return. Next is claim over residual income. Equity shareholders are referred to as residual owners, as they get dividend only after all other claims on the company's income and assets have been settled. Now you have to understand this, that of all the claims are settled, only thereafter shareholders has a claim over the income. Next feature is voting rights. Equity shareholders have voting rights in proportion to the shares held by the shareholders. They have a right to participate in the company's management also, as they are called the owner of the company. Next feature is limited liability. The liability of the equity shareholder is limited to the extent of capital contributed them in the company. I think everybody has well understood the features of equity shares and concept of equity shares. Let me tell you what are the merits of equity share. Number one advantage is ideal for risk-taker investors, or you can say ideal for adventurous investors. Equity shares are suitable for investors who are willing to assume risk for higher returns. Second advantage is dividends. It's no obligation. There is no burden or obligation on the company to pay dividend, as it depends on the profits available and the decision of the directors and members. This is the advantage for the company. Another advantage is source of fixed capital. Equity capital serves as a permanent capital. Long-term capital, companies taking the funds from the investors, so it is a source of fixed capital. Equity capital serves as a permanent capital, as it is to be repaid only at the time of liquidation of a company. Another advantage to the company provide credit standing. Equity capital provides credit worthiness to the company and confidence to prospective loan providers. Company can obtain loan from the financial institution, and as the company is credit standing is there. Another advantage is no charge on assets. Equity shares do not carry any charge against the assets of the company. As a result, assets can be freely mortgaged for the purpose of borrowings. Another advantage is democratic management. Equity shareholders enjoy voting rights also, as they are treated as members of the company. They are members of the company, which ensures democratic management of the company. They can participate in the affairs of the company, but as per the directors and as per the whosoever is holding the company, members have selected them as per their decisions. But equity shareholders always have a full right to participate in all the resolutions and all the decisions also. Now students, after discussing the merits of the company, let us see what are the limitations of equity shares. Number one is risk of fluctuating returns. Equity shares are not suitable for investors who desire to earn stable return on their investment, as equity shares get fluctuating return. If a company is earning profits, the shareholder gets more profit, more returns. But if the company is not having profit in some year or some other period, return cannot be there. So fluctuating return is there. This is a risk to the shareholder. Another is high cost of capital. The cost of equity share is generally more as compared to the cost of raising funds through other sources, as lot of expenditure is incurred by the company in raising the capital. Dilution of control. The additional issue of equity shares dilutes the control and earnings of existing equity shareholders. Next is legal formality. A company has to comply with number of legal formalities before issue of equity shares to the general public. As in case a company is starting raising capital as a first time, that is called IPO, initial public offer. For that, so many legal formalities has to be complied by the company. So legal formalities are more. Another is overcapitalization. Equity share capital is a permanent source of capital. If the company has raised excess capital due to faulty financial planning, then the company may get into a state of overcapitalization. In such a situation, equity capital may remain idle and underutilized. This is another limitation of equity shares. Preference shares. Definition of preference shares. I may tell you that preference shares are those shares which carry certain special or priority rights. Firstly, dividend at a fixed rate is payable on these shares before any dividend is paid on equity shares. That is why they are called preference shares. Secondly, at the time of winding up of the company, capital is repaid to the preference shareholders prior to the return of equity capital. Preference shares do not carry voting rights. This is another feature of preference shares. They have the preference over the capital, but they have no voting rights. However, holders of preference shares may claim voting rights if the dividends are not paid for 2 years or more on cumulative preference shares and 3 years or more on non-cumulative preference shares. This we will discuss later on in detail. let's see what is the definition of preference shares. Those shares which enjoy certain priorities in regard to payment of dividend at fixed rates and return of investments. So the preference shareholders enjoy two preferential rights over equity shareholders. Number one is right to receive fixed rate of dividend, and second is right to receive repayment of capital, that too on winding up of the company before the capital of equity shareholder is returned. Now let's see what are the features of preference share. Number one is fixed rate of dividend. Preference shareholders receive dividend at a fixed rate before any dividend is paid to the equity shareholders. Another feature is repayment of capital. Preference shareholders have preferential right as to the redemption of capital, that too only at the time of winding up of the company. Another feature is no voting rights. Preference shareholders generally do not enjoy voting rights. Another is no charge on assets. Preference shares are also issued without creating any charge on fixed assets of the company. For the preference shares can be classified into number of various types. Let us discuss one by one. What are the types of preference shares? Number one is cumulative preference shares. The preference shares which carry the right to accumulate unpaid dividend in future years in case the same is not paid in the current year are termed as cumulative preference shares. Another is non-cumulative preference shares. In contrast to cumulative preference share, we can say the preference shares on which dividends do not accumulate are termed as non-cumulative preference shares. If the company does not declare dividend for any year, right of dividend of such shareholder in respect of that year will be lost. That's why they are called non-cumulative preference shares. Another is participating preference shares. The preference shares in which shareholders are granted the right to share or right to participate in the surplus profit of the company after paying dividend on equity shares are termed as participating preference shares. But mind it that only after paying dividend on equity shares they have the participating rights. Another is non-participating. Similarly, as in case of cumulative non-cumulative, here also in contrast to participating preference shares, non-participating preference shares are in which shareholders do not carry the privilege of participation of surplus profits along with equity shares are termed as non-participating preference shares. Next is convertible preference shares. Preference shares that can be converted into equity shares within a specified period of time are known as convertible preference shares. It means they can be converted also. Another is non-convertible. Preference shares that cannot be converted into equity shares are known as simply a non-convertible preference shares. So students, we have discussed various types of preference shares. Now let us see what are the merits of preference shares. Number one is safety of returns. Preference shares are useful for those investors who want steady income in the form of fixed rate of return and safety of investment also. This is the benefit to the preference shareholders. Another is no interference in management. Preference shares do not affect the control of equity shares over the management, as preference shareholders do not carry any voting rights. Another advantage is trading on equity. The preference shares are entitled to a fixed rate of dividend. It enables the company to declare high dividend to equity shareholders during prosperity to take advantage of trading on equity. Another is repayment of principal amount. Preference shareholders have a preferential right of repayment over equity shareholders in the event of liquidation of company. This is the advantage to the preference shareholders. Another is no charge on assets. Preference capital does not create any sort of charge against the assets of the company, so assets may be used as security for raising loan in future. This is in favor of a company. These are the merits of the preference shares. Now let us see what are the limitations of preference shares. Number one limitation is limited appeal. Preference shares are not suitable for adventurous or bold investors who are willing to take risk and are interested in higher returns. Here it is a limited amount is given to the preference shareholders. Another is unreliable and low returns. Preference shares carry a fixed rate but low rate of dividend. Even during the bumper profit, preference shareholders have to be satisfied with a fixed dividend, while equity shareholders get a major share in profit. This is a limitation of preference shareholders. No tax benefits. There is no tax saving in case of dividend on preference shares, as they are not deductible from profit as expense. Another limitation is dilutes claim of equity shareholder. Preference share capital dilutes the claims of equity shareholders over assets of the company. So these were the limitation of equity preferential capital. Now let us wind up today for this class, this session, as we have discussed equity shares and preference shares, their merits, features and limiters, etc. So next session we will cover next source of owners fund. Today it's okay. Bye. Thank you.